Index funds have been around for over 30 years. But what are they and how do they differ from other investment funds? Glad you asked. An index fund follows or tracks the performance of a specific market index, like the S&P 500. An index is a hypothetical portfolio of securities created to measure the value of a specific market or segment of it. An index fund can be an ETF, exchange-traded fund, or a mutual fund. If you're not familiar with ETFs or mutual funds, check out our lessons on these before going any further. Because an index fund follows an existing market index, it's made up of a defined or set list of components and the number of those components. Given that, you can think of an index fund manager like a baker who's following a very detailed recipe. So, this would mean that if two companies were to offer the same index funds, there'd be no difference, right? Wrong. Although there might be no difference in the investments that make up the fund, there can be a difference in fees and expenses. So, even if the name of two separate index funds is the same, it's always a good idea to review the prospectus of each fund and compare. Index funds are considered passive investments because the investments within the fund are usually held for long periods of time with very little adjustments made. This typically leads to lower operating expenses and, in turn, a lower MER when compared to more active funds. A possible downside of investing in an index fund is that if the index it follows is declining in value, then so too will your investment. That said, a more actively managed fund has the potential to outperform the market. This can lead to a positive return for an investor even if the market is down. Of course, the flip side is true too. There is a risk that an investor can lose money if an actively managed fund is down more than the market is up. For many investors, index funds may be one efficient way to spread their money across many different investments. This is a diversification strategy, where a portfolio is made up of many different types of assets. And this is done in an effort to help offset the negative impact that one asset may have on the portfolio's value. However, if an index fund focuses on a specific type of asset or sector, then that offset may not happen. What do I mean by that? Let's say the only holding in a portfolio is the Electric Power Index ETF, and that ETF is only made up of electric company stocks. Do you think that portfolio is diversified? You might achieve better diversification if you were to buy multiple index funds that focus on different asset types or sectors in the equity market. Keep in mind, though, that buying more index funds means more transactions, which might lead to more fees or commissions. So be sure to check out the costs first. Remember, index funds are mutual funds and ETFs designed to follow the performance of an index. They provide investors with a managed product that usually has a lower MER compared to non-index ETFs and mutual funds. To learn how to research and compare index funds, watch our lesson on researching an index fund on Webroker.